What is up everyone? Today we're going to look at Netflix's latest earnings that they dropped yesterday. Before we even go into the details, let's just look at what they expected and what they actually got as a result. So we can see that they got higher revenue than expected, about 1%. Operating income and margin, they were also higher. They did fail on net income and diluted earnings per share. So then why did the stock price increase after the earnings? Well, here the last point is one of the most important ones to answer this question. They were expecting 4.5 additional memberships in this quarter, and they reported 7.66 million. So this is pretty drastic difference between the two, and that's pretty much explaining why the stock price was up so much in the past day. All right, so this is one of the most important part you need to understand about Netflix, is that there's a huge discrepancies between the net income and the free cash flow. So the company is overstating how much money they're producing basically, and the difference comes from the additions of content assets and the amortization of content assets. Those are basically the amount the company pays to produce content and the value of these assets / content that's increasing in value. So as you can see, these are not really cash flows entering the business. That's why I'm saying that the company is reporting or overstating how much they're actually producing. Because if you look here, the net income is 4.5 billion in 2022 and the free cash flow is only 1.6 billion. There's a big important difference between the two. So if you look at the PE, it would give you 33. For us that were interested in free cash flow, this would give us a multiple of 92. This is ridiculously high. Now, why do we care about free cash flow? It's because that's what the company uses to reinvest in themselves, to pay down debt, to share repurchase, to pay out dividends, or to just make acquisitions. And so this is why free cash flow is the metric that really interests us. Here they say that they will basically start focusing more in 2023 about generating more cash flow. And here in the bottom it says, assuming no material swings in forex exchange happens, we expect at least $3 billion in free cash flow for the full year of 2023. Now plugging this with the current market cap of 150 billion, this would give us a multiple of 50 for the price of free cash flow, which, not gonna lie, is still pretty high. Now the question is there any growth elements that would justify this kind of price of free cash flow? One thing we have here is a new revenue stream. As you guys know, Netflix a few months ago, they presented a new option for members, option number 2, which is $6.99 with ads. And this is a way for Netflix to create a new ad revenue stream. And lastly, in the bottom, it says this will build slowly over time, which means that this new revenue stream is going to take some time before it actually grows. It's not going to take off overnight. So just to keep that in mind. If you guys like this type of content and want to see more, feel free to subscribe. It would really mean a lot to me. Now here, this is another screenshot from their earnings report, and it says, we're encouraged by the fact that streaming overall accounts for less than 40% of viewing across these markets. So let's take US for example. 8% of the market share out of 40% that watches any type of content through streaming is using Netflix, which means that 1% out of 4 who's using any type of platform to watch their streams is using Netflix. That's a lot. And what this paragraph is, the point here that Netflix is trying to make, is that the remaining part here, which is all the remaining people who are using TV, and they're betting on the fact that these people will slowly convert into streaming platforms, which is what we're seeing in the recent years. Now, while I do think that this is a good point for growth, is this justifying the price of free cash flow that we've seen earlier of 50 according to their expectations? This is the ultimate question that we are always trying to answer. But what about all the other players? We have Disney Plus, Prime Video, Crave, Hulu, Apple TV, HBO. All these players are also competing for the same thing, to get all those people who are going to convert from TV to the streaming platforms. So this will be a challenge, right? These are big players too. Here's the forecast for the next coming quarter of 2023. They're expecting revenue of 3.9% increase year over year for the first quarter of 2023. So this is not bad of a growth for a quarter, right? But the ultimate question, as always, is this enough to justify a price to free cash flow of 50? For me, it's nearly not enough. Now let's look at analyst expectations. As always, we don't push too much weight into them, but it's still good to see which direction they're looking at. So we can see that these are not high double-digit growth that we would expect for this price to free cash flow. I mean, 7.5, 11.4, okay, and then it's slowing down drastically. So ultimately, this is not for me justifying a price of free cash flow of 50. And again, this is according to their expectation of $3 billion in free cash flow for 2023. Now, even if you believe that for some reason you'll prefer to look at the PE ratio because you don't agree with looking at free cash flow as something more important, then even so, the current PE ratio is at 31, which is still pretty high for these kind of growth rates. That was it, guys. Thanks for all of you who stuck till the end. I really appreciate it. If you have any video in mind you want me to do, please write it in the comments. Don't forget to like and subscribe, and I'll see you on the next one.